Hello viewers, not entirely sure who's going to be watching this, but this is for my clients and for prospective clients, anyone in our group, anyone out there on the internet wanting to know what's happening with the property cycle in Australia, what's happening in Sydney, and why the prices are falling, how far they're going to fall, what's going to happen, what will happen. And I just want to do this quick video to show you what's happening in the likes of a Sydney market and any market for that matter that runs through growth. I'm going to do a red color here. So I'm just going to do this. This is a property price graph. I'm going to do black. Sorry, my name's Lloyd Ross, by the way, Lloyd Ross. You can find my Facebook group, Property Investing Mastery, if you want, or you can jump online, Google me, and find me, Lloyd James Ross. Now, I'm going to, this is the baseline. The red line dictates a 10-year property cycle where property's growing at around about 5% a year or 4% a year for 10 years and it doubles in value. That's the normal 4% a year, 3 to 4% a year is typical property growth. 3 to 4% a year, 3 to a 3 here, and so on and so forth. And then at the end, you might get a 10% thing here, but across the board, it's around about 3 to 4% average price growth in property, plus a yield of 4 to 5% gives you 8.5% total return on property, which is the average return for property over the last 60 years in Australia. So if that line is the average growth rate, what we call the mean, that's another word for the average, the mean. What's happened in Sydney is it's gone like this. Okay, like that. And now it's obviously going like this, down a little bit by 4%, it dropped. And so it has gone way above the mean. Like property was growing in Sydney by 10% per annum for up to 4 years. Maybe even more, it's had like 15% 1 year, and 10 and 10, and then 15%. It was just skyrocketing, right? Had the Asian market in there. So 5%. So what happened was it actually grew by about 65% total in that time frame, in like 5 years, 6 years. And so what needed to happen was it needed to grow at this rate. So how far can the market fall? Well, there's a term in finance and statistics called reversion to the mean. Reversion to the mean. And things have a tendency to revert to the mean, okay, which is this long-term growth rate, the long-term growth rate, the long-term growth rate. So the property market in Sydney may well fall by 10 to 20% to revert back to, or maybe 30%, back to the mean, okay? It will revert back to the mean. I don't know how far it's going to fall. I don't have a crystal ball. I don't know. But it is reverting back to the mean already because it's coming off its 4% growth rate. If it grew at 10%, 15% forever, it denotes a bubble. It was just getting to bubble territory here. And the reason being is that the yields got down to 3%, which is small yields. So it needs to revert back to the mean and the yields need to move back up to 5%. So this will fall. It'll drop down to the mean. It may not go all the way to the mean, but it'll go close. And so we're in for probably a fairly rough ride in Sydney for the next few years. The other thing it can do is it doesn't need to fall to the mean, but the mean can actually catch up to it over time. The mean will go up and it will catch up. So it might fall, or actually not even fall, but stay steady. If demand's high enough, supply's low enough, it'll stay steady and flat. So the actual property prices don't always have to fall, but the mean over a number of years will catch up to it. So it might take another 4 years to catch up. And that the current levels will become the new mean. And so it could take 4 years for that to happen. And you'll see plateauing for 4 years as the mean growth rate catches up to the higher growth rate. So the growth rate here, the green one, will be flat at 0% for 5 years or 4 years, whatever it might be. And the mean will slowly over time catch it and it'll intersect. And then it'll be where it should be. But as it approaches the green, the green will actually start to pick up and grow again. So that's the next cycle, and this is when it'll happen, okay? So it's not the end of the world. The world's not falling down. The sky's not falling down. Property can't go to zero if there's a growing population. It defies all economic logic and economic rule, mathematics. It will not. While the population is growing and land is finite, the supply of land is finite. Property values are not going to go down. So yeah, as to what this is going to be, it could be 2 years, 3 years, 4 years, but it'll have to catch up to the mean. When it does, we'll get the next cycle. So buckle up in Sydney, buckle up probably in Melbourne too, because this is happening in Melbourne. It'll get to a point where it just cannot grow anymore. Probably doesn't do that. Statistically, it's got to fall. And yeah, if you're in Southeast Queensland, you would have seen that we are probably at about this stage of the cycle. So we've got probably got 2 to 3 years of this before it starts to do the same thing. And then we'll be in a correction. And then Perth is probably way back here. So it's gone through its big boom and its bust, and it's now relaunching. All right. So hope that gives you some information or guidance as to what's happening in these major capital cities with the property market. Rest assured, interest rates aren't going to spike. They're probably going to stay flat for another few years, 3 years, which is bad news for retirees, but good news for property investors with debt. So you can pay off your debt, which is fantastic. You've got 3 or 4 years, low interest rates, record low interest rates. Well, at the end of those 2 to 3 years, lock in a low rate and then obviously pay your debt off. That is the key. Then you'll have passive income, which is also exciting when you retire. Okay, that's enough from me. I'll talk to you guys again soon. Lloyd James Ross signing off.